We're talking the strongest macro forces driving gold today with Kevin Rich. He is the consultant to the Perth Mint based here in New York City. Welcome back, Kevin.
Hi, David. Nice to see you again.
Nice to see you too. Gold has had a nice run up to $1,900. It's been consolidating in that range for a couple of weeks now. Kevin, what has been the major driver of gold since we last spoke a few months ago?
I think, David, the major driver of gold so far this year has been I'd say clearly the U.S. dollar and dollar strength or dollar weakness. We entered the year gold around $1,900 an ounce in January, and the dollar had been trending down throughout all of last year, and it kind of caught everyone by surprise that in Q1 the dollar strengthened and gold off the back of that dropped about 10% down to the 1,700 range. And interest rates started to peak a little bit on the 10-year and other instruments. That reversed about a month and a half ago, and the dollar returned to the lows it started the year at, and gold reacted, as you would expect, right back to the 1,900 range. So I think it's very a dollar-driven market right now.
Well, that leads to the next obvious question is what's been driving the dollar?
Well, I think it's the massive stimulus amounts that we're talking about. I think the return of inflation, and the question is it transitory inflation or is it really inflation at all? Are some of the numbers we're seeing just a result of the hangover from the pandemic? The supply disruption affected everything, so you can't just turn things back on. Housing is in a boom because of low interest rates and people are staying home, and as a result, lumber is through the roof. You can't tell me lumber is going to sustain these prices going forward, just because I think it's really just a hangover from the COVID lockdown.
I want to talk about geopolitical risks for a bit now. Some people suspect that gold reacts positively to geopolitical shocks. Wars, conflicts, anything that would cause fear amongst the marketplace. Is that true, Kevin? Is that something you've observed?
Well, we've observed that historically. Like it used to be when a tanker was on fire in the Middle East or something like that. Oil would react. Gold would react strongly. When there was tension in between Israel and other countries, gold would react to that. But recently, like in the trouble between the Israelis and in the Gulf back and forth, gold beyond, it didn't really react to that. Russian troops, massing on the border of Ukraine, gold didn't really move to that. So it's been very much a financial and dollar-driven market right now, not geopolitical risk. I'm not sure if that sustains in the future, but that's what we've witnessed over the last few months.
You brought up oil. I think that might be the important third variable bringing this correlation together, because when there's a war and when oil is involved, when there may be a shortage of oil, I think the expectation is that inflation would pick up. And maybe that's why gold reacts, not to the war itself, but to higher inflation expectations from a shortage of oil. Isn't that, would you say that's the case?
Yeah, I mean, I'm not old, and I'm almost old enough that I had a whip inflation now button on my lapel, but not quite. But I do remember oil lines and oil rationing, and when all the oil came from the Middle East. And I think over the last several years, the U.S. Energy industry has done a great job of through fracking and other measures of making us less dependent on Middle East oil. So the shocks in that area are not nearly as notable.
Okay. Well, you remember, you must remember the start of the 80s, and of course we had stagflation towards the end of the 70s following the OPEC oil crisis. Some economists think we're going back to that, Kevin. Some people think that we're going to get high periods of inflation, which would be good for gold, and low periods of growth, which I guess arguably would be also very good for gold. What do you think of that scenario?
I guess, that's kind of the Japan scenario, basically, where they've just done so much to their economy without stimulating it properly. I think when we came out of the financial crisis, 2008, 2009, there was stimulus, but the growth was and the recovery was somewhat more anemic than people thought. Through the Trump years, I think the growth ramped up when there was less regulation. So I think how much the White House and Congress does on the regulatory side that maybe hamstrings the economy in the U.S. will affect that growth. So I think that we'll have to kind of wait and see how that looks.
It's funny because we talk about, well, some people talk about gold as a safe haven asset. Not everybody agrees that it should be, but some people think that it is. And it's ironic because we've already seen so many shocks over the last couple of years that I don't know of any other events that could possibly trigger a fear scenario right now amongst investors. We've had a pandemic. Prior to that, we've had a financial crisis. We've had a tech bubble. Over the last 20 years, we've had several conflicts in the Middle East. I mean, what could possibly get worse now from Kevin? What? It seems like we need something really bad to spook the markets enough such that gold will be triggered by fear alone.
I think what might really be bad is exiting all the things you just talked about, because had you listen, in 2008, 2009, had we just let the markets take their toll, the auto industry would have been crushed and things like that. But we had stimulus come in, and that support was was recognized. Since the pandemic has started, there's unprecedented monetary and fiscal support from the government, through unemployment, stimulus checks, ETF buying, bond buying, so the government is fully supportive of these markets. So that's why gold has kind of moved to the back burner and is not considered so much a safe haven, because what's to be safe for? The government's protecting all the markets. So I think that the exit of that, though, is going to be very telling. And we're starting to hear the early indications that the government's going to be putting some of, say, the corporate ETFs that they bought and the bonds and things like that. And so I think we're going to start to see some of that fall out. And if you think about what, back to the great financial crisis, the government support for the markets, the bond buying was in effect up until 2013. And when they pulled the rug out, when they stopped doing that, that's when you saw like the real pain in the gold. 2013 had a huge rundown. Gold was off 28-30%, I think, nearly that year, and outflows in investment products around $40 billion. So that was a big hit gold took when the Fed kind of pulled out their support. So I think the Fed was going to be very careful this time, and so it may be we may have a few years to run with a supportive Fed. And the other thing that happened in 2013 when the Fed did that, the dollar strengthened and inflation did not return. Now I think the fear is, with all this money that's been printed, all the debt's been added, that when the Fed steps back, that the dollar weakens and inflation comes raging back.
So let's put all this together, Kevin, and we'll talk about ETF flows and other specific indicators we might look at. Let's put all this together. What are some of the major drivers of a higher gold price that you would be looking out for? If I were to tell you gold's going to go to $3,000, for example, let's make that hypothetical scenario. What needs to happen in the economy or in the world for that to happen? Well,
I think the return of inflation, and I think a weakening dollar is kind of will lead to that. I think also weakness in the equity market. So if the support from if GDP numbers don't come back as strongly as we hope, and if we can't get this unemployment versus employment situation under control, and the government has to step back, eventually the equity markets are going to portray that, and that's going to be good for gold.
Mm-hmm. Okay. Let's run through all these three scenarios that you've, let's break it down. So you mentioned inflation needs to go higher, the dollar needs to weaken, the equity markets need to be more volatile. Let's start with inflation first. You said earlier to me, the inflation shocks we've seen are just a result of the supply bottlenecks. So do you think that inflation could be persistent right now? 4% annual inflation was last month's reading. Do you think we can continue to see that? Or do you think prices will fall a little bit back to normal?
Well, I think if they're absent the pandemic and everything we've been through, when you needed a really tight labor market to create wage inflation to get real inflation into the economy. And and I mean, we were almost in a position of that before the pandemic. And unemployment was very low, and labor was getting very tight. Now that reversed during the pandemic, and so now the problem is you have like so many variables all changing at once. When you're in a chemistry lab and you're doing an experiment, you change one thing at a time to see what that effect is. So now we have a lot of people, a lot of jobs were lost. Some of them are back and can't be filled. Some of that's because the unemployment benefits are sweeter than going back to work. But yet we see inflation, even though labor is not tied at all, and that may be because that's again supply disruption and not true inflation. So they may be the brains in Washington may be right in that this is transitory and it's not real endemic inflation ahead. But we'll just have to see.
So it's not entirely certain if we're going to get really high levels of inflation. So that's the first variable. Dollar weakness. We've seen, like you said, continuous dollar weakness. Actually, I'm looking at a DXY chart, the dollar index chart. Ever since basically last July, it's been trending down. Economists I've spoken to have predicted this. They cite monetary stimulus and unprecedented money printing as a reason for why the dollar would decline. Makes sense. But get this, Kevin, the Fed has recently said that it is now thinking about raising rates. So it's not impossible that they will do it. What if they do that before the other central banks around the world? What if the Fed raises rates first before the ECB, the Bank of Canada, or the Bank of Japan? Wouldn't that mean the dollar could strengthen?
Well, yeah, absolutely. And but I think they would only do that if the economy was really on the right track and they saw it potentially overheating. If the economy is still anemic and we just added all this debt, adding more debt load by raising rates it would be ludicrous. So, but I think you're right this is not a U.S. situation; it's a global situation. And my colleague in Australia at Perth always quotes John. He quoted Johnny Cash recently. He doesn't always quote Johnny Cash, but he said, Johnny has a song where he says, I put on my cleanest dirty shirt. And so the dollar may be like the worst currency you could imagine unless you compare it to everything else that's out there.
Mm-hmm. Yeah. All right. Well, I'm a Johnny Cash fan myself, so I'm gonna have to look up that song later. The third variable, equity markets. Will it be volatile? Now, I'm getting mixed signals from this from different analysts I've spoken to. Most people agree that valuations are rich. Most people think that this is from a valuations perspective, this is the highest we've been since basically the financial crisis of 2008 and 2009. If you look at the PE ratio, it's at 2007 levels. So where do we go from here? Can it get even higher in terms of valuations, or is this due for correction?
I'd say it's hard to imagine there's not a correction ahead, but it's dangerous to try to predict when that occurs, and it probably occurs when rates do start to move up, and again we've talked about why that may or may not happen. So I think if interest rates do pop for some reason, I think that's going to be negative for the equity markets.
Interest rates do pop. Okay. Well, you said it might be a while because they need the economy to be fully back on track. So basically, we've got all right. So let's put all this together. You're saying we've got a bit of some more room to climb for the equity markets. It's unlikely that they'll raise interest rates anytime soon, so the dollar could fall further, and inflation is, well, it may pick up, but most likely they'll hover around the same place for the foreseeable future. Is that a good summary? It looks like we've got some competing forces for gold, not a clear cut right now.
And you know what? That's just the nature of gold. It's got so many things tugging at it. You got physical demand. In Asia, in China, and India. Looked like it was kind of returning. That was crushed last year, but looked like it was returning. But every time it returns, and you see a premium building in one of the markets, there's some selling that brings it back to a discount. So I think so the physical demand is not back in gold. I think we've seen the inflows on the ETF side are kind of mirroring what's happening with the dollar.